Good afternoon, everybody. I'm Gary Cooper of Cooper CPA Group. I'm an accountant and a drummer. So now we're going to drum down on 5 tax planning strategies and let you know typically the 5 most common. Number 1, have a full projection prepared. Going in and just having a meeting and having somebody look at your previous tax return and you talk through what you've done may not answer all the questions. Being thorough is very important. And guess what? It's your money. If you want to minimize your taxes, you want to go at the highest level possible to do so. Number 2, understanding where you are. So you know how much money you made during the year. You know what kind of business operations you have. So having that understanding yourself that you can convey that to the CPA to where they can materialize it for you is so very critical. The 2-minute drill, what is that? That's football. No, it's tax planning. You get down at the end of the year, and we call accelerating expenses, deferring income, investing in certain initiatives that's going to minimize taxes. That's part of the 2-minute drill. You may invest in real estate, you may harvest losses, accelerate expenses. All these things come down in the last 45 days of the year because guess what? You get past December 31st, it's all history at that point. Basis limitations. Well, what is basis? Well, basis is what, if you're in a flow-through entity, it's what pre-tax income, less distributions, plus what you put into the company. That creates your basis. Well, you may think you have a big loss at the end of the year, but if your loss exceeds your basis, you got to suspend that loss. So it's very, very important, all the flow-through entities you're in, S-Corps, partnerships, that your CPA is able to compute your basis every year and you know where you set. We've already mentioned it, but harvesting losses. Taking a look at your portfolio, getting with your financial advisor, getting with us. If you've got a bunch of capital gains during the year and all of a sudden you've got some dogs in your portfolio, well, guess what? You sell those dogs, you wait 30 days to buy them back, they offset the gains and you don't pay taxes. So these are some strategies that are really important. Lastly, it may sound small, but non-cash deductions. Okay, take all the stuff you don't wear and use, take it to Salvation Army or Goodwill. Let me tell you what, thrift store values are a lot higher than when you may think. And we've seen $500 deductions turn into $5,000 deductions. So it's your money, but these strategies will help you minimize your taxes. Thank you very much. Have a good evening.